Can we invest and make a good profit off of Australian public companies? This video will go through the ins and outs of the Australian stock market. We will also make a breakdown of all major sectors, and we will look at and make a fundamental analysis of the biggest publicly traded Aussie companies. Stay until the end of the video if you want to extract the maximum value for your time spent. Hello friends and welcome to the Market Watcher, a place for gathering traditional financial and all other investment knowledge on a regular basis. Subscribe to the channel, hit the like button and leave a comment about which future topics you want us to cover here on the channel. As always, everything said here is with educational purposes only and should not be considered to be financial advice. The biggest Aussie stock market is called the ASX, which is short for the Australian Stock Exchange. It is comprised of 200 public companies, with the smallest one being above the $200 million mark, while the biggest companies are close or above the $100 billion mark. When it comes to their market capitalization, the ASX index is weighted according to market cap, so the larger a company, the more share of the total index it takes. For example, company number 199 out of 200 listed companies will take a much lesser share than the biggest company, which currently is BHP. Constituents are selected by a committee from Standard & Poor's and the Australian Securities Exchange. Let's now look at a chart which shows the growth and trajectory of the ASX over the last 3 or so decades. When looking at this chart provided via Trading Economics, we see that the overall gains of the ASX over the period are good. In 1992, the index was at 1600 points, while nowadays it is sitting at close to 6,900 points. This is a near close to a 4x on your initial investment. This means that for the last 30 years, the average yearly compounded return was about 5%. Just for some context, over the same period from June of 1992 until the autumn of 2022, the S&P 500 index, which tracks the 500 largest US companies, went from 400 points to 4,000 points. This is a 10x on your initial investment or an 8% annualized compounded return for the last 30 years. So over the last 30 years, the S&P 500 has beat out the Aussie major index. What is interesting is that since the 1900s, the Australian stock market has had the second best compounded return out of all global equity markets, with a 7.3% return. On first place is South Africa with a 7.4% return. So in this case, looked from a longer time horizon, the Aussie stocks have beaten out the American stocks. We discuss all major global returns and markets in a separate video on the channel, so don't forget to check it out, as we will provide you with incredible knowledge and understanding of the market cyclicalities and the overall sentiment cycles. Rebalances are conducted quarterly in March, June, September and December. Those rebalances are done so that the list of 200 companies is always legitimate, fresh and checked accordingly. If a significant event occurs like a delisting, merger or others, an intra-quarter rebalance may be conducted. A minimum of 2 business days notice is given to the market. If a person wants to buy the whole index, he can do this via an ETF. The most important thing when looking at an ETF is its management fee, also called an expense ratio. The lower the number, the better. Other major things to look out for in an ETF are the AUMs, or assets under management. The higher the number, the better. This shows how much funds are allocated to this ETF. The more money being allocated, the more trust this ensues, and also we must look at the date the ETF has started to operate. The longer the better, as it also helps us with the trust and security issue if the ETF has a longer life. The best ETFs can be found via the services of Vanguard, BlackRock or Fidelity. These institutions will provide you with the lowest TER or total expense ratio expenses, while providing the highest AUM funds with the longest history. Now let's take a look at the sector breakdown of the whole Aussie stock market. The two biggest industry sectors are the financial services with a 26.6% share, and the other major sector is the basic materials sector with a 21.9% share. The financial sector includes all banks, insurance companies, and all other traditional financial institutions. The biggest financial companies here are the Commonwealth Bank, the National Australian Bank, and Westpac Banking Corporation, while the basic materials sector includes Australia's biggest mining, exploration and refining companies. In general, Australia is famous for its large deposits of base and precious metals. The biggest material companies are BHP, Fortescue Metals and Rio Tinto. If we take a look at the sector breakdown pie chart, we will see the percentage share of all 11 sectors. On spot number 3 is the healthcare sector with a 10.4% share. The biggest companies in this sector are CSL Limited, Ramsay Healthcare and Sonic Healthcare. On fourth place is the industrials sector with a 7.8% share, with the biggest company being Transurban Group, and on second place the Brambles. Down the list on number 5 is the consumer cyclical sector, also called the consumer discretionary sector. In this sector, all restaurants, hotels, luxury goods, car companies and others are included, which provide consumer with wants but not needs, meaning they profit off non-essential living items and services. The biggest players in this sector are West Farms Limited and Aristocrat Leisure Limited. On the real estate side of things, the biggest players are Goodman Group and Center Group, which play the role of REITs or real estate investment trusts, which are entities who provide investors with easy access and high liquidity real estate exposure in Australia. The communication services sector has a 4.9% share, and the biggest companies here are Telstra Limited and Rea Group. Again, with a 4.9% share is the consumer defensive sector, also called the consumer staples sector. Here the companies provide consumers with mostly needs, which means essential services and goods for a normal way of living. Woolworths Group and Coles Group are here. The best performing sector overall globally over the last 1 to 2 years. The energy sector is on spot number 9 with a share of the Aussie stock market of 4.7%. The biggest companies here are the Woodside Energy Group and Santos Limited. The technology sector, also called information technology, in the Australian index, unlike the S&P 500, is quite small with only a 4.1% share. For comparison, the tech sector in the S&P 500 is about 25 to 30% share. The biggest Australian publicly traded tech companies are WiseTech Global and Computershare Limited, while the sector with the smallest share is the utilities sector, which tracks water, gas and electric companies which provide the infrastructure or services needed for this essential for a normal way of living services. APA Group and Origin Energy are the biggest players in this sector. Now that we know the ins and outs of the Australian stock market, let's make some fundamental analysis on several of the largest Aussie companies to see if they have high debt levels, do they have low valuations compared to their assets and earnings, and we shall see the overall efficiency performance of these companies. For this, we will examine 4 different key fundamental metrics. the debt-to-equity ratio, which tracks debt levels compared to the shareholders' equity. Then we will check the price-to-earnings ratio, which examines if the company's price is over or undervalued compared to the company's net earnings. After which we will discuss the price-to-book value ratio, which takes into consideration the value of the company compared to its shareholders' equity or book value. The two are synonyms. And the fourth metric we will take a look at is the return on equity, which is one of Warren Buffett's favorite metrics. It is used to see with what efficiency the companies are using their capital. We will discuss 4 different companies: BHP, Rio Tinto, Commonwealth Bank, and CSL. These 4 companies are the largest Aussie companies in each of the top 3 sectors of the Australian stock market. Let's start with BHP and Rio Tinto, which are both leaders in the materials sector. The information comes from Guru Focus, one of the best websites for financial metric information. BHP has a DE ratio of 0.37, it has a PE of 8.37, a PB ratio of 2.85, and its ROE is 33.52%. While Rio Tinto has a DE ratio of 0.27, its PE is about 6.04, the PB is 2.04, and its ROE sits at 35.33%. So from a strictly fundamental point of view, Rio Tinto is currently the better option. Its debt levels are a bit lower, its valuation compared to its earnings is lower, which is better. For every dollar of earnings of BHP, we pay $8.37, while for a dollar of earnings from Rio Tinto, we pay up only $6.04. For each dollar worth of shareholders' equity for BHP, we pay $2.85, while for Rio Tinto, we pay $2.04. And the efficiency of the capital is higher for Rio Tinto, which is better. It is important to note that only 4 metrics are not enough to make an adequate investment decision, but these 4 metrics gives us a very comprehensive start to our analysis. Now let's take a look at the Commonwealth Bank. The debt-to-equity ratio is 2.08, which is much higher than 1, and it is not good. The price to earnings is 15.91, which is very high for the banking sector. The price to book value is 2.23, which is also high for a bank. We want as close to a 1 as possible or below 1 when we examine the PB ratio for a bank, while the return on equity is 14.28%, which is acceptable according to Warren Buffett. Above a 12% return on equity is a good number. In general, the Commonwealth Bank does not look very appealing from a fundamental risk perspective, plus in hard economic times, supplemented with a recession, the banking sector does quite poorly when it comes to performance. Now let's take a look at CSL Limited. Its debt to equity is 0.66, while its PE is 45.96, which is incredibly high, and it is quite abnormal. The higher the PE, the lower the potential future returns will be. The PB ratio is also extremely high for such a healthcare stock with a 7.19. This means for each dollar of equity we pay up to $7.19, while a considered good level for a healthcare stock would be below 3. The return on equity is good with a 18.5% level, and with this we end our video about the Australian stock market. Subscribe to our channel, like the video and hit the bell icon so that you won't miss out on any of our future content. Goodbye for now, and I'll see you in the next video.